Bitcoin in plain English.
Welcome back to Bitcoin in Plain English.
Yeah, so glad to be sitting down for this one.
Pull up a chair. Just imagine we are sitting together at a cozy, quiet cafe. We're just two friends sharing a warm coffee and, talking about the future.
Sounds perfect. And I mean, it is a pretty wild future to think about. Right now, it is March 2026.
Yeah, March 2026. It's truly amazing to stop and think that Bitcoin is now over 17 years old.
Over 17 years.
Right. It was created way back in January 2009. We have seen so much history happen since that very first day.
We really have. So what is our focus for today?
Well, today we are taking a deep dive into a really fascinating stack of research. We're looking at historical price charts, some famous interviews with the businessman Michael Saylor, and a collection of notes on the psychology of long-term investors.
Okay, that sounds like a great mix.
Yeah. Our topic today is the long game, why patience builds wealth.
I am so glad you are joining us at the cafe today. Our mission for this deep dive is to look really closely at the mindset of holding on to your investment. Because we want to show you that getting rich is not about making clever, stressful trades on your phone. It's not about watching a computer screen all day long and worrying about every little price change.
Which is what everyone thinks it is.
Exactly. Building real wealth is actually about finding the right asset and then doing the hardest thing in all of investing, absolutely nothing.
Okay, wait. I want to make sure I really understand this because it sounds almost too easy.
It sounds easy, yeah.
Right. So I have a big question to start us off. How do wealthy people actually get rich? When I look around at normal life, having a high salary usually is not the secret.
No, it's really not.
Because, people who make a lot of money at their jobs usually just spend a lot of money. They buy expensive cars, they take expensive trips, they eat at fancy restaurants, and at the end of the year, they have nothing saved.
Yeah, you hit the nail on the head. A high salary does not create wealth if you just spend it all by the end of the month.
So what is the real secret then?
The real secret is surprisingly simple. Wealthy people buy assets that go up in value over time, and they hold those assets for decades.
Decades, okay.
Think about it like planting a tree. You do not plant a tiny seed in the ground and then dig it up every single week to check if the roots are growing.
No, of course not. You'd kill it.
Right. If you do that, you will stress the plant and the tree will die.
Yeah.
Instead, you plant the seed in good soil, you water it, and you wait. You wait for years.
Just leave it alone.
Yeah. And one day, that tiny seed becomes a giant tree that gives shade to your grandchildren.
That is a very clear picture. You plant the seed and you leave it alone so it can grow. But I want to push back gently here.
Sure, go ahead.
I understand planting a tree, but how does this work in the real world with actual money? Can we look at some real historical examples from our research?
We certainly can. Let's look at gold first.
Okay, gold.
So in the year 2000, 1 ounce of gold cost about $280.
$280.
Yep. Today, in March 2026, that same ounce of gold is over $2,900.
Wow. That is a massive increase in value.
It is. But here's the catch that most people forget. Gold did not go up in a straight, smooth line.
It didn't, no.
Between the years 2011 and 2015, gold crashed hard. It lost 45% of its value during that time.
45%. Losing almost half of your money is terrifying. I can completely understand why a normal person would panic and sell their gold when they see that happening.
That is the core of the problem. The people who panicked and sold their gold during that crash completely missed out on the huge price recovery that came later.
They dug up the seed.
Exactly. They dug up the seed. Now, let's look at an example closer to home for many of our listeners. Think about the Korean real estate market.
Oh, yeah, apartments.
Right. The average apartment price in Seoul has roughly tripled over the past 15 to 20 years.
That is a famous example. Everyone always talks about the people who bought apartments in the Gangnam area in the early 2000s.
Precisely. The people who bought those Gangnam apartments and simply held on to them are very wealthy today. But let's think about the reality of holding that real estate.
What do you mean?
Think about the families who got scared. Imagine a family that bought an apartment, but then the 2008 global financial crisis hit. Or think about the market slowdown in 2013.
Right. The news on television was screaming that the economy was collapsing.
Yes. Those families felt a deep fear in their stomachs. They panicked, and they sold their apartments because they were afraid of losing everything.
And today?
Today, they look at the prices in Gangnam, and they feel deep regret. They missed the massive price rises because they let fear beat their patience.
Hearing that really makes me feel the pain of selling too early. It is easy to look back and say I would have held, but in the middle of a crisis, the fear is very real.
It is very real.
And I guess the story of Bitcoin is exactly the same.
It is the exact same story, but it moves much, much faster. Let's look at the price charts from our sources.
Okay, let's see.
In 2015, one Bitcoin was about $200.
$200.
Yeah. And as of right now, in March 2026, it is ranging around $80,000 to $90,000.
That is an unbelievable jump.
But to get from 200 to 90,000, Bitcoin holders had to survive brutal, painful crashes. The price dropped by 80% in 2014.
80%.
It dropped another 80% in 2018. And it dropped another 80% in 2022.
Okay, let me summarize that to make sure the picture's clear. If I bought Bitcoin 10 years ago and held it, and my neighbor bought it at the exact same time but sold it during one of those scary 80% crashes, we have totally different financial lives today.
Entirely different.
We started at the same point with the same asset. The only difference between us is patience.
That is exactly the lesson. The asset goes up over the long term, but you only get the benefit of that growth if you are still holding it at the end.
I understand the logic, but that brings up a word that scares a lot of new investors. Volatility.
Ah, yes, volatility.
When the price jumps up and down so dramatically, dropping by 80% isn't that dangerous. How does someone actually find the bravery to not sell when their savings are dropping that fast?
It feels risky, yes. But our research today introduces a completely different way to think about it. Michael Saylor is the CEO of a company that holds a massive amount of Bitcoin.
Right. We've talked about him before.
He has a famous saying about this exact fear. He says, volatility is not risk. Volatility is vitality.
Volatility is vitality. That is an interesting phrase. For our listeners who might not know, vitality means life or living energy.
Exactly.
But how does that work in finance? How is a changing price a sign of life?
Think about your heartbeat. If you are hooked up to a monitor in a hospital, your heartbeat goes up and down, up and down. That movement is volatility.
Okay, I see.
If your heartbeat stops going up and down and becomes a perfectly flat line with zero volatility, what does that mean?
It means your heart has stopped. It means you were dead.
That is correct. A flat line means you are dead. Up and down means you are alive. Volatility is a sign of life in a free market.
That makes sense.
But here is where it gets really interesting for our deep dive today. Michael Saylor argues that this terrifying volatility is actually a gift to you and me.
Wait, I have to stop you there. A gift.
Yes, a gift.
When I lose half my money on paper in 1 month, it does not feel like a gift. How is a stressful price crash a good thing?
It is a gift because of how the big financial players act. If Bitcoin had zero volatility, if the price just went smoothly and safely straight up forever, every billionaire, every giant government fund, and famous traditional investors like Warren Buffett would have bought all of the Bitcoin a long time ago.
Oh, because it would be perfectly safe.
Right. They would see a perfect, safe, easy asset, and they would buy it all. But because Bitcoin crashes 50% or 80%, the big money gets scared.
Oh, I see the connection now. The big traditional investors see the crashes, they worry about their quarterly reports, and they say, no way, that is too risky for our clients.
Yes, that is the core of it. Think of Bitcoin like a very scary roller coaster at an amusement park.
A roller coaster?
Most people walk by, they look up and see the terrifying loops and the huge drops, and they say, no way, I am not getting on that ride.
Because it looks too scary.
Right. Because the ride looks scary, it scares most people away. And because it scares people away, the lines to get on the ride stay short.
That is a great point.
That means brave, ordinary people still have a real chance to get a ticket and get on the ride. The fear keeps the billionaires away long enough for regular working class people to buy it and build wealth.
I really appreciate that roller coaster analogy. The scary drops keep the line short for the brave people.
Exactly.
But practically speaking, when you are actually sitting on that ride and falling, it is still very hard to be brave.
It is very hard. That brings us to another famous analogy from Saylor's interviews. Imagine you are sitting at a casino table playing a game of Texas Hold'em poker.
Okay, poker.
You look down at your cards,
Yeah.
and you see that you have a royal flush.
For our listeners who do not play card games, let's explain that. A royal flush is the absolute best hand you can possibly get in poker, correct?
Yes, it is a 10, jack, queen, king, and ace, all of the same suit. The mathematical chance of getting a royal flush is about 1 in 650,000.
Wow.
It is a perfect, unbeatable hand. So Imagine you are holding this perfect hand,
Right.
but the game is still going. The poker table is very loud. The other players are bluffing. They look confident.
It's noisy.
Very noisy. Some people are yelling and throwing chips. The lights are bright, and you start to feel nervous. You think, maybe I should fold my cards. Maybe I should just give up and leave the table.
But folding a royal flush just because the table is noisy seems like a terrible mistake. You have the winning hand. The noise does not change your cards.
It would be a terrible mistake. And yet, selling your Bitcoin because the price dropped this week or because the television news is scary is exactly the same thing.
Because you're reacting to the noise.
Right. You are holding the best financial asset ever created, and you are throwing it away because of temporary table noise.
I want to play the role of a skeptic here.
Go for it.
It is easy to say we have a royal flush, but how do we actually know it is a royal flush? How can we be so sure Bitcoin is the best hand?
That is a great question. A royal flush is only good if you know the rules of the poker game. Knowledge is what gives you the confidence to hold.
Okay.
Let's quickly remember what we learned in our previous discussions on this show. First, we know Bitcoin has a fixed supply of exactly 21 million coins.
Right.
It can never be inflated or printed by a government. We discussed that deep scarcity in episode 3.
Right, yes. And in episode 4, we learned that it acts as the ultimate store of value. It combines the portability of money with the scarcity of prime real estate.
You have got it. And we also explored in episode 5 how it is the most secure computer network ever built in human history.
So those are the rules of the game.
Yes. When you truly understand those rules and you understand the engineering, you realize you are holding the unbeatable hand. When you know that, the short-term noise at the table matters a lot less.
Okay, so if the strategy is this simple, just hold the winning hand and ignore the noise, why do so many people fail at it? Why do people still sell?
Because it is simple, but it is definitely not easy. Human psychology gets in the way. Our notes highlight 4 big enemies of patience that we have to fight every single day.
4 enemies. What is the first one?
The first enemy is the 24/7 news cycle.
Oh, absolutely. The news is always so negative. Every time I turn on the television or open a news website, it says Bitcoin crashes or real estate bubble pops. It causes a lot of anxiety.
That anxiety is intentional. Negative news is designed to make you emotional. When you are emotional and scared, you click on the article to read more.
And clicks make money.
Exactly. Those clicks make money for the media companies. The news is not designed to help you build calm, long-term wealth. It is designed to keep you anxious and engaged.
That makes a lot of sense. What is the second enemy of patience?
The second enemy is social media. You look on your phone and you see someone bragging about making a 500% gain on some random altcoin. You see people showing off sports cars and expensive watches.
Let's stop and define that term for our listeners. What exactly is an altcoin?
An altcoin is simply any digital coin that is not Bitcoin. The word stands for alternative coin.
Got it.
They're usually much smaller, much more confusing, and much riskier than Bitcoin. When you see someone on social media claiming they got rich quick on an altcoin, it creates a powerful illusion.
It makes you feel like you are falling behind. It makes you feel like your safe, boring strategy is wrong. And it makes you want to take big, dangerous risks to catch up with them.
That is precisely the danger. But remember, social media is not reality. For every one person showing off a lucky 500% gain on social media, there are hundreds of people who lost all their money.
But those people are silent.
Exactly. They do not post about their failures.
So what's the third enemy?
The third enemy we face is the human urge to do something. Humans are built for action. When prices drop, your brain yells, sell and run away. When prices rise quickly, your brain yells, buy more now.
We just want to react.
Right. But in investing, the best move is usually no move at all. Warren Buffett has a very powerful quote about this. He said, "The stock market is a device for transferring money from the impatient to the patient."
A device for transferring money from the impatient to the patient. That is a brilliant way to explain it.
It really is.
The impatient people panic and sell, and the patient people quietly buy it from them.
Exactly.
Yeah.
And the fourth enemy of patience is short-term thinking. People are always thinking in months instead of decades. They always ask, what will the price of Bitcoin be next month?
Which is the wrong question.
That is completely the wrong question.
So if what will the price be next month is the wrong question, what is the right question we should be asking?
The right question requires what we call a 100-year mindset. We need to shift our time horizon.
100 years.
Yes. I challenge everyone listening to stop thinking about a 5 to 10 year timeline for their investments. Start thinking about 50 years, 100 years, or even 200 years. Think about what will help your grandchildren in the year 2080, or your great-grandchildren in the year 2120.
That is a very long time. Most people do not think past their own retirement. Thinking about great-grandchildren in 2120 is a huge shift in how we view money.
It is a huge shift for normal people, but traditional old money families have always thought like this.
Old money families.
Yeah. Families with old money in Europe, like the famous Rothschild family or wealthy families in Korea, have kept their wealth for centuries. They did this by buying physical land, holding heavy gold, or creating complex legal contracts called trust funds to protect their money for their children.
But those old methods have a lot of problems, don't they?
They do.
Land can be seized by a changing government, or it requires constant taxes and repairs. A house from 100 years ago needs new roofs and new pipes. Gold is really heavy and hard to protect from thieves. And those legal trust funds require very expensive lawyers to manage.
You have listed the exact problems with physical wealth. Physical things decay, and they require trust in other people. This is why Bitcoin is the first perfect asset in human history for generational wealth.
Why is that?
It has a superpower. You can store billions of dollars of wealth directly in your head.
You mean by memorizing a 12-word seed phrase?
Yes. A seed phrase is just a list of 12 simple words that acts as the master key to your Bitcoin. If you memorize it, you can carry your wealth anywhere in the world.
Without anyone knowing.
Exactly. Nobody can seize it from you. It cannot be inflated by governments printing more paper money. And it never, ever decays. Your Bitcoin today in 2026 is mathematically exactly the same as it will be in 2126. It requires no maintenance.
So when people say they're going to hold their investment for 5 years, they are thinking way too small.
Way too small.
This is really about building a wall of wealth for our families that lasts forever without needing a middleman or a bank.
That is exactly it.
So what exactly should we do today? What is the practical plan for our listeners to actually build this?
The most effective strategy is actually the most boring strategy. It involves 4 simple steps. Step 1 is to set up automatic buying.
Automatic buying.
This is called DCA, or dollar cost averaging. You simply set your bank to buy a small fixed amount of Bitcoin every week or every month, no matter what the price is.
So you do not even look at the price when you buy. That removes all the emotion and stress from trying to guess the perfect time. What is step 2?
Step 2 is to move your Bitcoin off the public exchanges. Put it into cold storage.
Let's define that.
Sure. An exchange is like a public bank on the internet. It is convenient, but you do not fully control it. Cold storage means putting your Bitcoin on a hardware wallet, which is like a small, disconnected personal safe in your own house. It gives you total control.
Got it. And step 3?
Step 3 is to write down your 12-word seed phrase very safely on paper or metal. Those 12 words are your generational wealth plan. Hide them well and make sure your family knows how to find them if something happens to you.
And what is the final step?
Step 4 is often the hardest part for people today. Delete your trading apps from your phone. Turn off your price alerts. Stop checking the price every single day.
Stop checking the price. That sounds simple, but I imagine it is very difficult in practice when everyone else is panicking.
It is difficult, yeah.
But it makes so much sense to protect your peace of mind.
It does. Michael Saylor has a beautiful guiding philosophy for this exact feeling. He simply says, buy Bitcoin, hold it forever, and do something great with your life.
I love that.
The Bitcoin will take care of itself over the decades. Your job is to focus on your family, your career, and your health.
Buy Bitcoin, hold it forever, and do something great with your life. I really love that perspective.
It's powerful.
Well, before we wrap up our deep dive today, we always like to do a quick vocabulary review for you, our listeners. It helps to make sure these important English concepts really stick in your mind.
That is a great idea. Let's review the key terms we use today to build our long-term mindset.
First is store value. For example, we said Bitcoin and gold are good stores of value.
Right. A store of value is an asset that keeps its purchasing power over a long time. It protects your hard work so your saved money does not lose its value.
Next is volatility. We use the heartbeat analogy for this.
Volatility simply means big price swings up and down. Remember, it is a sign of life in a market, and it gives patient people a chance to buy.
What about net worth?
Your net worth is the total financial value of everything you own, minus your debts. It grows steadily when you patiently hold valuable assets instead of just spending your salary.
And the famous internet word, HODL.
HODL is the popular crypto slang term for holding onto your investment tightly and never selling, even when the market gets very scary.
Next, we have conviction.
Conviction is a deep belief and a strong understanding. It is knowing you hold a royal flush in poker, which stops you from panic selling when there's loud noise around you.
Almost done. We talked a lot about generational wealth.
This is money and financial security that is passed down to your kids, your grandkids, and your great-grandkids over 100 years or more.
Finally, the strategy. DCA, or dollar cost averaging.
DCA is buying a set dollar amount of an asset on a regular, automatic schedule. It's the absolute best way to remove human emotion from investing.
Thank you for breaking those words down so clearly. It really helps bring the whole topic together.
It is my pleasure. Before we leave you today, I want to leave you with a final thought to mull over.
Go ahead.
We talked a lot today about the anxiety of watching price charts. Just imagine what you could achieve in your career or in your personal life if you took all the anxious energy you spend worrying about the news and just put it into living your life.
That's a great point.
Imagine fully trusting that your long-term wealth is secure. Think of the art you could make, the business you could build, or the peaceful time you could spend with your family.
What a beautiful thought to end on. Just live your life and let the tree grow. Well, thank you so much for joining us at the cafe today. We really appreciate you taking the time to learn and explore these ideas with us. We will see you next time on Bitcoin in Plain English.